We haven't spoken to you in a while, Mohamed, because there was a weekend. What do you got for us this morning? I put out a picture of Times Square, and I was going to put new normal or new abnormal, but I decided just not even to call it anything. But it's very quiet, too quiet. But what came into your mind over the weekend in terms? You got to be some new things. You bullish, bearish, feeling better, positive, negative, what?
First, good morning, Joe, and thanks for having me. Look, overall, the market call is a little bit more nuanced. It's not as urgent warning about a major correction as it has been, but for most investors, I think you still want to be cautious out there. But there's two areas I think we're not focusing on enough, if I may, Joe. One is those people who entered this defensively and have a massive appetite for volatility. They're starting to be real pockets of value, and they should be looking at that. On the other side, those who are still holding on to corporate credits with really weak balance sheets and don't want to sell because their prices have plunged, remember one thing. The earnings picture is being absorbed. The next round is the balance sheet picture. And defaults are really destructive of value. And if you're still in these very low-rated companies with no cash, debt maturing, you're betting on bailouts, and you're betting on generous bailouts. So understand what you're betting on, because this is a very tough environment, not just for earnings, but for balance sheets.
Right. And in the end, do you really? I mean, should you just assume that these politicians are going to get it together? I mean, if they don't, it could be what you just described would not happen. But for some reason, it just seems like eventually that old expression that they'll eventually do what's right after looking at all the alternatives and finally settling on that. Is it right?
Yeah, I'm pretty confident that this is going to be the same as we saw with TOP. The first one doesn't get through. Then the market gives a very clear signal. But it's not the market. I've participated in a number of town halls. People are suffering. There is real pain in the street. This is an economic sudden stop that takes away your livelihood, that makes you feel insecure, that takes away goods from shelves. I mean, this is a real hit, and people are looking to Washington to do something. But understand, this is also a really tough policy design. The best you can do right now is protect and contain the damage. You can't erase it overnight. That's a health issue, not an economic and financial policy issue. You've got to do that. But designing it's tricky, and I think we're going to see much bigger emphasis on people than companies compared to 2008. And that distinction is going to have implications for different segments of the markets.
All right. We've gotten some, you've actually put numbers on, not everyone does that, but numbers on the eventual levels that we'll see on the S&P and the Dow. Have you changed your forecast there? It's like a fool's errand to try and really get too specific about it, but you think we're closer to the bottom than we are to the top at this point, Mohamed?
I think we're closer to the bottom. I was worried because our initial conditions, people tend to forget what initial conditions are. It really matters where you start from in terms of what you get to. We were very stretched. We were very stretched because liquidity had taken over as the main driver of markets. I think we have unwound most of that, but we've also created dramatic damage in the process. We haven't heard yet of pain in the asset management industry. That's going to be your next round of stories because there are massive outflows going on. So, that's why, yes, we've come a long way, and we've certainly got to the 30% I was worried about. That was the upper end of the range when I said reassess at that point. We've gotten to the 30%. But I'm still, for most investors out there, I still tell them, be cautious because we are in completely uncharted waters here.
Okay, Mohamed, thank you. Watching the workings of all the yields and the Federal Reserve Bank and the Fed, you don't see any big problems. And listening to Kashkar, did he make you feel comfortable that the Fed can respond to whatever needs to be done in the workings of the credit markets?
So, I was very critical of the Fed a week ago, telling you that I was both baffled and upset with what they had done, less so starting on Tuesday when they finally focused on market imperfections and started moving. As Steve said, a lot of damage was created in the interval, but they've moved on 3 market segments, and we're already seeing stabilization of the Treasury market, and that is great news in so many ways. The one thing that I noticed yesterday, and I'm really surprised they haven't done it yet, and Kashkari mentioned it, is municipals and corporate credit. Those markets are still dislocated. Those markets are still causing a lot of stress in many different areas, and I'm really surprised we haven't seen anything yet. I know it takes the Treasury's backstop on this, but I think that is an urgent area for policy action.